Okay, let's finish up chapter 4. Here is where we left off. Okay, so there's going to be 4 closing entries. Okay, one entry is going to close revenue, one entry is going to close expenses. And here's what they would look like. Okay, we're going to make the revenue accounts equals 0 via the income summary account. Okay, so remember, the income summary account is a new account that we've created, and we're basically going to dump everything into it, and then we'll close the income summary account. Okay, so the whole purpose of this is to dump revenue and expenses into that one account. Okay, so we're going to transfer revenues and then expenses into income summary. So this is what it would look like. Service revenue currently has a credit balance of $6,500. In order to make it equal 0, we have to put a debit for $6,500 on the T account. So this is the journal entry. So service revenue, there's our debit for $6,500. Okay, that's how we're going to zero it out. And then we're going to take and add it to income summary. So if we debit revenue, income summary has to be the opposite. Debits and credits have to equal. So the income summary is going to be 6,500. So what's going to happen now is in income summary, we'll have a credit balance of 6,500. And in service revenue, we'll have a balance of 0. Because we had a credit balance of 6,500, we just put a debit of 6,500. That's going to make this account equal 0. Okay. We're going to do the same thing with expenses. With expenses, we had debit balances of 1,000 for salaries expense, 500 for supplies expense, 1,000 for depreciation expense, and 400 for utilities expense. These were all debit balances. Well, if I'm going to make them equal 0, I've got to credit them the exact same amounts. So then I'll have a debit and a credit for the same amount. Each account will then have a balance of 0. So there's my credits. Now this time I've got a debit income summary. So I debit it for the total of the 4 expense accounts, which is 2,900. So my debits and my credits are equal. I credited all these accounts for the same amount that was in them, except it was on the debit side. So now each one of these accounts will be 0. And now in my income summary, I have a credit for 6,500 and a debit for 2,900. So that's how I'm going to close these out. Now, this is what it would look like when I put it into their T accounts. Okay, this is taking the journal entries and moving them into the ledger or the T accounts. Okay, so here's revenue on the credit side of 6,500. And here's expenses on the debit side for 2,900. Okay, now I added 6,500 to the debit side of service revenue. Remember, this is net. This was our revenue right here. Okay, this is service revenue. So by putting 6,500 on this side, the balance of revenue is now 0. Okay, so 6,500 in revenue was the original balance. I added 6,500 to service revenue on the debit side, and now this one has a 0 balance. I also offset that by adding 6,500 to the income summary. So now I have a credit balance and income summary of 6,500. So our service revenue is done. Service revenue, we journalized it, we posted it. It now has an official balance of 0 in revenue. So now that means that starting the first day of the next month, we'll be starting fresh with a zero balance. The next thing we did was we took and we credited all of our expenses. We had a debit balance. We credited them. Okay. And if you need to, go back a slide and see the journal entries. We credited expenses for $2,900. Now this has a zero balance. Okay, so all we're doing is we're taking whatever the balance is in these two T accounts, revenue and expenses, and we're simply going to put the same dollar amount on the opposite side so that it's equal to zero. Now, what was our other account? It was income summary. So I moved 6,500 to income summary on the credit side. Now I'm going to put 2,900 for expenses on the debit side. Okay, so let's go back and think about this for a minute. Revenue, 6,500, expenses, 2,900. What have we said the difference between them is? Net income. So the balance in income summary is now 6,500 minus 2,900, 3,600, and that's the exact same thing that was our net income before. So if you go back to the worksheet, you go back to the income statement, every place where it said net income said 3,600. So now we've got 3,600 as a balance in our income statement. There's net income. So we've just summarized revenue and expenses into income summary. And the difference between them is net income. At the same time, we zeroed out both of these so we can start fresh the next day, okay, which would be the first day of the next month. So now we've only got one account open here, income summary, for $3,600. Okay. Revenue minus expenses equals net income. So here's our last two closing entries. The first thing we have to do is we have to close out income summary. Now, if you'll notice the numbers, this is basically how we take and add net income to Josie Smith Capital. We had a credit balance in income summary. So we're going to debit it for 3,600. That will make income summary zero, nothing in it. So we can use it again at the end of next month. We add a credit to Josie Smith Capital because it's an addition to her existing credit, her existing balance. So now we've got 3,600 debit for income summary, $3,600 credit for Josie Smith Capital. So I just adjusted formally the account for Josie Smith Capital by $3,600. Debits and credits are equal. Income summary is now zero. And Josie Smith Capital has just had her net income added to her balance. One thing left to do. She took out $1,000 withdrawal. We have to subtract that from her capital account. So we're going to do a journal entry first to recognize that. So how do we do it? Well, the normal balance on a capital account is a credit. So if we're going to subtract 1,000, it's got to be a debit. So there's a debit for $1,000 to Josie Smith Capital. I want to zero out withdrawals. Since that had a debit balance, I'm now going to credit it for $1,000. So now Josie Smith's withdrawal account is zero, and her capital account was just reduced by the $1,000 that she took out. So now the balance in Josie Smith's capital account should be the same as what was listed on the balance sheet and in the statement of owner's equity. Okay. So here's how that would look. income summary has a balance of $3,600, and it's right here on the debit side. So to zero this out, okay, well, it's the balance is on the credit side. As you can see, that's the bigger number. So we're going to put 3,600 on the debit side and 3,600 on the credit side, and that's adding net income to Josie Smith Capital. We're going to take and zero out her withdrawals by putting a credit on the credit side and a debit on the capital account. So that's the subtraction. So now what we have is a balance of $15,800, 13,200 plus 3,600 minus 1,000 is 15,800. Now the Josie Smith capital account balance is the same as what we saw on the statement of owner's equity and on the balance sheet. And we've just done our 4 closing entries, okay? So we closed out revenue, we closed out expenses, we closed them out to the income summary, and that gave us a balance that was the same thing as net income. We added net income to Josie Smith's capital, that zeroed out income summary, and then we closed out her withdrawals by subtracting those from her capital account, and then there's our balance. So checks and balances are built in all over the place. If we did everything right, the balance and income statement should be the same as net income on our various documents. And if we did everything right, Josie Smith Capital's ending balance should be the same as we see on our other documents, okay? So this was the statement of owner's equity from previous, okay? After the closing entries, the capital ends with a balance of $15,800. And we can trace this balance right back to the statement of owner's equity. So that's what I was talking about right there. Okay, we started out with the May 1st balance. We added net income. We subtracted withdrawals, and that's how we came up with it. There's the T account that shows the exact same thing. I started out with 13,200. I added 3,600. I subtracted 1,000. Same thing that's here. My balance is the same. So there's your checks and balances. If these numbers don't match as you're going through it, then that means we've made a mistake someplace and we've got to find it. Okay. So in this exercise, we're going to practice preparing closing entries. The company's first closing entry for the company is to close revenue. So this is a company called Oceanside. Oceanside's revenue account is service revenue, and it's going to be debited so that we have a zero balance, okay? The balance is currently $110,900. So to zero that account out, it's going to have a debit balance. We're going to have to debit it because it's got a credit balance. So we're going to debit $110,900 to service revenue. And then we're going to add it. We're just going to shift it over into the income summary account by a credit. Okay, this has to be a credit and this has to be a debit, because if you look at the T account, you'll see that the balance for service revenue is on the right side. So to make it zero, you've got to put it on the left side. Okay, and then debits and credits have to equal. So if I have a debit for $110,900, I also have to have a credit for $110,900. So that's income summary. So all I've done is I've taken service revenue and I slid it into the income summary account. Now I'm going to do the same thing with expenses. Here's Oceanside's expenses, okay? They had debit balances, salary, supplies, depreciation expense furniture, depreciation expense building. because these had debit balances or balances on the left side, to zero them out, I have to put the exact same amount on the right side or the credit column. So there they all are. I add these up and I'm putting 35,000 into the income summary. Remember, if you're not sure, geez, do I debit income summary? Do I credit income summary? Well, start from the beginning. Look at the account you're trying to zero out, see where the balance is. To zero it out, you've got to put the exact same amount in the opposite side. So figuring it out that way, that means these are credits. Well, if this is credits, then the debit has to be for the same amount on the opposite side. Otherwise, debits and credits wouldn't equal. They have to equal. So we add 35,000 to the debit side of income summary. Now, each one of these expense accounts has a balance of 0. So this is what it would look like. We debited service revenue for 110,900. Now that has a 0 balance. And we shifted it, we just moved it over to the income summary account by debiting or crediting income summary for 110,900. In our second one, we credited expenses for 35,000 and we debited income summary for 35,000. So now expenses are 0. Income summary has a balance on which side? The right side or the credit side. It's going to have a balance over here and it's going to be 75,900. What does that number represent? It represents net income, okay? So you've got net income now as the final number in income summary. Revenue are closed, it's 0. Expenses are closed, they're 0. Income summary has the net income value in it of 75,900. Now we're going to take and we're going to close income summary and we're going to add net income to the capital account, okay? So the capital account is going to have a credit balance. So if I'm adding to it, it has to be another credit. If I'm going to zero out income summary, it has a credit balance, which means I've got to put in a debit. So I do a debit for the same amount, 75,900. That makes income summary 0. I add 75,900 to the capital account. So that's going to increase the balance by that much. And that'll give me my new balance for Pipeline Capital. The last thing we have to do is we have to subtract the withdrawals. Now, they took out $59,000 in withdrawals. Withdrawals have a debit balance. So I'm going to credit the account for $59,000. That will make withdrawals 0. And I'm going to debit capital for $59,000, which will subtract $59,000 from the capital account balance. And that will give me my up-to-date capital balance, and withdrawals will be closed. They'll have a 0 balance. So there's the 75,000 net income. That's being added to the capital account. That's why they're on the same side. And then I'm going to zero out withdrawals, 59,000. And I'm going to put it over here as a minus to the capital account. My new capital account balance is $62,900. So I've closed out all of my accounts, updated the capital account. There's my 4 closing entries, okay? Now, the post-closing trial balance is really the same thing as all the other trial balances. Basically, what we're going to do is we're going to list all the accounts again. This time, we're going to list all of the balances that have been totally affected, which means the expense accounts are gone, the revenue accounts are gone, income summary is not going to be there. All that stuff is gone because it's all been updated and added to the capital account. So all those accounts are going to be gone. And this is what we're going to be left with. This is the remaining accounts with balances in the ledger. Now, in the ledger, you're going to have a lot of other accounts that have nothing in them. That's going to change as the month goes on and we have transactions. Okay, those accounts will start to fill up again. And at the end of the month, we'll do the same thing and we'll zero them out again. For now, our post-closing trial balance, we're simply going to take all of our accounts with the new balances. We're going to list them. And again, everything should be equal, 25,500, 25,500. Okay, there are no temporary accounts left. Revenue, expenses, or withdrawals are not included because they're closed. They have zero balances. Okay, the ledger is now up to date and ready for the next period. The post-closing trial balance contains the same accounts that the balance sheet contains: assets, liabilities, and capital. It's presented in the post-closing trial balance. Okay, and that's it. We've done our closing for the end of the period, and we're ready to start up for the next period. The next few things, this is something that I've talked about before, just some housekeeping things. The first one is liquidity. It measures how quickly an item can be converted into cash. And remember I said that when we start listing accounts on the worksheet and on the balance sheet, we list them in order of their liquidity. How quickly can they be converted? The most quickest one, of course, is cash. So that's going to be our first one. After that, accounts receivable generally, because that one's going to be liquefied soon. As people pay me, I get cash. So everything is going to be listed in order of how quickly they can be converted into cash. That's called liquidity. This is the operating cycle. The operating cycle basically talks about the flow of cash and goods and services, kind of how our business flows, okay? Cash is used to buy goods and services. Goods and services are sold to customers. The business collects cash from customers, and then it buys more goods and services. And it's just a cycle. It goes round and round and round. Something else we talked about, current versus long-term. Current assets can be converted to cash, sold, or used up during the next 12 months. That defines them as being current. Examples would be cash, accounts receivable, supplies, prepaid expenses. If they're going to be sold or used during the next year, converted to cash, then that would be considered a current asset. And they use the term operating cycle. And the reason for that is because, as we said earlier, not everybody's accounting period is a calendar year. Some of them are a fiscal year. They start in the middle, like a school district, for example. So we use the term operating cycle versus years so that there isn't a confusion. It's basically 12 months. That's how we define it. Any assets that we're going to keep after 12 months are considered long-term. So these are not converted to cash within the current year or operating cycle. Some examples: plant assets such as land, building, furniture, equipment, and long-term investments or other assets, anything that's going to be with us for more than 12 months. Those are considered long-term assets. It's important that we know the difference between short-term and long-term assets, because we're going to learn some basic business ratios. And business ratios, some of them use total assets, some of them only use short-term assets. So we need to know the difference so we can compute these business ratios correctly. Now, current liabilities use the same concept, except they're liabilities. So they have to be either paid with cash or goods and services within 1 year or an operating cycle. So it's within 12 months. But now we're talking liabilities versus assets. So they either have to be paid with cash or goods and services over 12 months to be considered, or under 12 months to be considered current. Over 12 months would be long-term. So accounts payable, notes payable due within 1 year. This is an interesting concept because we might have some notes that go, let's say, 5 years. Well, the amount that's due within the next 12 months is considered a current liability, and the amount that's due from starting in year 2 through 5 would be considered a long-term liability. So something else that we're not going to get involved in right now, but by definition, that's how that would work. Every year, a new amount would be considered current, and the remaining parts would be considered long-term. Long-term is going to get shorter and shorter and shorter because it's being paid up, and eventually it'll run its course and the entire note will be paid. Salaries payable are going to be current liabilities. Interest payable, there's always going to be interest due within 12 months, and any unearned revenue. Long-term are not due within the current year or operating cycle. Okay, these would be notes payable with due dates over 1 year. Mortgages, that's another one. So anything that we owe that's not going to be paid within the next 12 months is long-term. Now, that's also important because on the balance sheet, if we're going to really be specific and classify these, then each asset and each liability as either current or long-term is going to be listed that way. So using the previous example, the company's classified balance sheet is shown. Note that there are headings for current assets, plant assets, and current liabilities. There's subtotals for each. The company does not have any long-term liabilities. If it did, then they would appear beneath the current liabilities. Going by the rules of liquidity, your current assets and current liabilities will come first in their respective headings, and then long-term will come after, okay? So this is just a more detailed balance sheet. It's the exact same thing. The only difference is we've classified assets as current and long-term, and we've classified liabilities as current and long-term. That's the only difference. If somebody was looking at your documents and wanted to calculate certain business ratios, they would need it split up this detailed in order to do it. We're not going to get too much into balance sheet forms. You can either do a top and bottom or a side by side. It's sometimes easier for the top and bottom. Remember, we have to have these in a format where outsiders who are looking at them can readily understand what they're looking at. Sometimes the side by side can be a little confusing, but the top and bottom one, that one's usually a little bit easier to comprehend. So me personally, I like the top and bottom one. So I mentioned that part of the reason we need to separate these is because we're going to learn some basic business ratios, okay? The first one we're going to learn is the current ratio. We're also going to talk about the debt ratio. And these are used to evaluate a company. So if somebody's looking at your financial statements, there's a reason for it, okay? We just don't show anybody these things. It could be because they're going to invest in the company. It could be because we're asking for a loan. We're looking for money. So they're going to want to do some business ratios based on the financial statements that we give them. So that's why we have to do this. So the first one is the current ratio. The current ratio is very simple. It measures a company's ability to pay its current liabilities. And the rule of thumb is it's a good, strong current ratio if it's 1.5 or above. Okay, so let me explain that a little bit further. It measures a company's ability to pay its current liabilities. Okay, that's what it is. The ratio is computed as follows: current assets are divided by current liabilities. A company prefers to have a high current ratio because that means it has plenty of current assets to pay its current liabilities. A current ratio that has increased from the prior period, that indicates an improvement in the company's financial position, okay? So if a strong ratio is 1.5, what that's saying is for every dollar of liability, you have $1.50 in current assets. So that's good. If all your assets came due within a year, you would have $1.50 to every dollar of liability to pay those off. And that's what that's telling us. So there's the ratio right there. Current assets over current liabilities. That's why we have to break those up. That's an important ratio for our business. Now, the second decision aid, and that's what these are, is the debt ratio. It measures an organization's overall ability to pay its debts. The debt ratio is computed as follows. Total liabilities are divided by total assets. The debt ratio indicates the proportion of a company's assets that are financed with debt. We're always going to have some liability. I mean, remember what liabilities are. Liabilities are a claim to our assets, whether it be our money or to our other assets. Liabilities are a claim to our assets. So this indicates the proportion of a company's assets that are financed with debt. A low debt ratio is safer than a high debt ratio. Okay, basically that's just saying that fewer assets are financed with debt. And of course, the fewer the better, the lower the better. A company with low liabilities usually has low required payments and is less likely to get into financial difficulty. The rule of thumb for the debt ratio is that below 60% is considered safe for most businesses, as it indicates that the company owes only 60 cents for every dollar in total assets. So that's a good thing. So that's our rule of thumb. A debt ratio above 0.8 or 80%, that borders on high risk. That means that 80% of our assets are financed by debt. That's dangerous, okay? Now we're getting a little bit too high, and that's dangerous as far as our company's existence. And that is the end of chapter 4. So take a look at chapters 1 through 4, and you can work on the worksheet with the financial statements and the adjustments and the closing entries, and you should be able to complete the entire process. There's 3 practice problems. So start on those, and we'll talk about them in more detail in class. Thanks very much. Have a good day.